By the time a company's earnings report tells you it's winning, the stock has already moved. The real story isn't in the headline number. It's buried 3 pages deep in a filing almost nobody reads, the capital expenditure line. Today I'm going to show you how tracking one number, how much a company spends building its own future, can help you spot tomorrow's market leaders while everyone else is still staring at last quarter's chart. If you're new here, this channel is all about breaking down how real investors think, without the jargon and without the hype. No get-rich-quick nonsense, just the actual signals professionals track before a stock takes off. Hit subscribe if that sounds useful, because today's topic is one of my favorites. Capital expenditure, or CapEx. Section 1. What is CapEx really? So what is CapEx? In plain English, it's the money a company spends on long-term stuff. Factories, servers, machines, land, R&D infrastructure. It's different from regular operating expenses, which cover the day-to-day running of the business. Here's why it matters. When a company spends on operating expenses, it's paying rent, this month's bills. But when a company spends on CapEx, it's placing a bet on what it thinks the next 5 to 10 years will look like. Think of it like a farmer. Operating expenses are buying seeds for the season. CapEx is buying the tractor, building the irrigation system, expanding the land. One feeds you this year, the other decides how big your farm can get next decade. Section 2. Why earnings reports are already old news. Most retail investors treat the quarterly earnings report like the finish line. Revenue beat, stock jumps. Revenue miss, stock drops. But by the time that report drops, the decisions that created those numbers were made 12, 18, sometimes 24 months earlier. CapEx is the opposite. It's forward-looking. When a company dramatically increases its CapEx, it's telling you, right now, where it expects to be competitively positioned years from now. You're not reading the past. You're reading a forecast the company is making with its own money. That's the core idea I want you to walk away with today. Earnings tell you what already happened. CapEx tells you what a company is betting will happen. Section 3. The pattern. How to actually read CapEx. Here's how I break it down when I'm looking at a company's spending. First, look at the direction, not just the size. A company spending $20 billion a year isn't automatically bullish. What matters is whether that number is accelerating year over year or plateauing. Second, check where the money's going. Is it going into buildings and land, more static, slower-moving assets? Or is it going into things like custom chips, proprietary data centers, or in-house technology? The kind of infrastructure competitors can't easily copy. Third, compare CapEx to free cash flow. If a company is spending more on CapEx than its free cash flow can comfortably support, that's a company making an aggressive, high-conviction bet. It's not necessarily a bad thing, but it tells you management believes the payoff is worth the short-term financial strain. Fourth, compare it to competitors in the same sector. CapEx numbers only mean something in context. A company spending big relative to its rivals is trying to pull ahead. A company spending less might be playing defense, or might be capital discipline for a reason. Section 4. The 2027 angle. Now here's where it gets interesting for where we're heading. Several major tech companies have been dramatically ramping up spending on things like custom processors, data infrastructure, and next-generation manufacturing capacity. Historically, this kind of spending cycle takes a few years to show up in actual revenue and margins. Companies that build the infrastructure first tend to have a durable head start, because that kind of capacity isn't something a competitor can spin up overnight. It takes years of lead time and billions in commitment. That's why I'm watching current CapEx trends as a leading indicator for who might be sitting in the strongest competitive position by 2027. Not because I have a crystal ball, but because heavy, sustained infrastructure investment today is often the clearest public signal of where a company expects to compete hardest tomorrow. Section 5. The risks. Don't skip this. I want to be upfront. Heavy CapEx isn't automatically a green flag. Companies can overspend. They can build capacity for demand that never shows up. Some of the biggest corporate write-downs in history came from CapEx bets that didn't pay off. So this isn't a spend equals win formula. It's one piece of a bigger picture. Something you layer on top of margins, cash flow, and competitive position, not something you trade on by itself. Section 6, how to use this yourself. If you want to start tracking this yourself, here's the simple version. Pull up a company's cash flow statement. It's public, free, and takes 2 minutes on any financial data site. Look for the capital expenditures line. Track it over the last 3 to 4 years. Ask yourself, is it accelerating? Is it going toward things competitors can't easily replicate? And is it happening alongside healthy cash flow? Or is it stretching the company thin? Do that across a handful of companies in the same sector, and you'll start to see who's actually playing offense and who's just maintaining. Outratio. That's the CapEx signal, one of the quietest, least hyped numbers in a financial report, and one of the most useful if you know where to look. If this helped you see earnings season a little differently, subscribe for more breakdowns like this. No hype, just the signals that actually matter. Drop a comment with a company whose CapEx you want me to break down next, and I'll cover it in a future video. See you in the next one.